Hello, and welcome back to our Commodity Spotlight series. Today we're going to be focusing on gasoline. Now, I'm not going to go into the nitty-gritty of gasoline, as most people have cars and most people understand what gasoline is. We're going to discuss it more from an inventory standpoint, as when it comes to the different types of gasoline, which we're going to get to in a moment. We'll discuss some trading characteristics of it. We'll discuss a little bit of the technical picture, and we'll wrap it up with advice on whether you should explore gasoline or if it might not be for you, as well as some correlations and seasonality. With that being said, let's get started. So gasoline has two different types, but not octane types. There's something called pad 1 and pad 5. So every Wednesday at 10:30, when the numbers come out, the EIA gives out gasoline inventories, but then when you dig deeper, there's two types. There's pad 1 and pad 5. Pad 1 represents the East Coast. Pad 5 represents the West Coast. The difference between the two is pad 1 is more densely populated with high demand, but fewer refineries, and pad 5 has more refineries available to it. Some of the other differences is that pad 1 is more reliant on imports, particularly from Canada and Europe, whereas pad 5 is more self-reliant on crude production in the U.S. When you're thinking pad 1, you're usually thinking New York, New Jersey, New England, Pennsylvania. Those are the more densely populated areas. Obviously, pad 5, West Coast, you're thinking California, Arizona, states of that nature. Now, pad 5, although it does have more supply in terms of domestic crude, it is becoming a little bit more reliant on imports as well. When you're looking at these numbers, you need to pay attention to both pad 1 and pad 5. That will give you a hint as to what demand is looking at. It's not just the headline number. The headline number is always deceptive. You have to dig a little deeper just to understand what's going on with the inventories. So that gets the inventory picture out of the way. Seasonality plays a factor in the way gasoline moves. In the summer months, it moves a lot more. It's more active than heating oil. And in the winter, heating oil becomes more dominant. The ticker is RB on the CME. It trades in thousandths of a penny. Each tick is equal to $4.20. By nature, it is very wide and sweepy. It's not a tight instrument. So when you're trading this, you need to be aware that your slippage could be anywhere from 10 to 15 ticks, just based off of the way it trades. So it's something to keep in mind. It's not for everybody. Products being gasoline and heating oil, they're really not for everyone. They could get very volatile, and the books are relatively thin. The volume is relatively thin compared to crude and natural gas. And if you're not careful, you could really get caught and you could get clipped. If, let's say, your stop could get filled 20, 30 ticks above or below where you thought you were going to get out, if it gets really sweepy on a wacky type of move. So at $4.20 a tick, every 10 ticks obviously would be $40. You could get hit a little bit harder on stops than you would imagine. Heating oil and gasoline, I'm going to repeat it with the heating oil as well, are not the types of instrument that you could really size into. Again, the volatility and the thinness of the book makes it more complicated, and you have to have a little bit more stomach for it. They're not for everybody. It's very important. It's not for everybody. With that being said, some of the correlations that when you're looking at gasoline, specifically in the summer, on inventory days, what do the gasoline numbers look like? Because they will have an effect on crude. Now, crude is the papa, but on inventory days, if the inventory builds are too large, and gasoline can take everything down. Gasoline, and usually if gasoline's big, then heating oil is usually big. And no matter what crude is, gasoline and heating oil can bring crude down or take it up, depending on what the numbers look like. So you really, like I said, you really have to be careful with it. Just technically looking out at it, you can see it's really chopping around, which is very uncharacteristic for it now in the summer driving season. We're now in June and it should be moving up. It's not. What that's telling you from a just overall common sense picture is that supply is outstripping demand. We have more supply than we have demand. So you have to be aware that because we have more supply on the market than we have demand, prices are not going up. They're not acting like they normally would in a seasonal factor. So if you look back, let's say to July of last year, even June, you could see we were significantly higher. We were trading 250, 240s. We were really moving up 260s, whereas now we're at $2.08. We're not really having that same kind of aggressive move to the upside. This is very basic and a beginner guide. It's really to get you familiar with it, understand how this thing moves. Again, I want to preface this by saying one more time, this is not for everybody. Gasoline and heating oil are not for everybody. There's no micro. You cannot heavily size into these things because you could get hurt very quickly. They're very wide and they're very sweepy. However, they are part of the energy space and we weren't going to cover it. So with that being said, I hope this video was informative. I look forward to seeing you on the next one.